Good evening to all the students. Welcome to this next video of revision. In the previous class, we had started with the unit 1 of chapter 1, that is the last chapter. Let us start with the second unit of the fourth chapter, that is international trade. And the name of this chapter, name of this unit is the instruments of trade policy. Now, please understand this before we could revise anything about this unit. You have to understand what exactly the gist of this entire unit. It is nothing but, as we learned in the unit 1, that what is the importance of international trade and how it is beneficial for the countries. At the same time, we also learn that many of the countries are very protectionist about their own country. That is, they don't like the free flow of goods and services for various reasons. We have seen the arguments in favor of international trade and also so many arguments against the international trade. Hence, to control the international trade, the various countries use a lot of measures, okay, or they use a lot of tools, and these tools are discussed in the form of instruments of trade policy in this unit. Now, broadly, this unit can be divided into three different parts. Now, the first part over here are called as tariffs. Second part are non-tariff measures. And third one is export related measures. Of course, when I say tariffs, I'm talking about the various types of levying tax on the goods and services which are moving from one country to another country. Non-tariff measures means they are mostly, they're mostly in the form of rules and regulations that, the criteria that you have to meet in order to do foreign trade. And export related measures are some of the measures which are used to promote exports and all that, right? Now, historically, if you see, as a part of protectionist measure, as I told you, the governments or different countries have applied many different types of tariffs or policy instruments. And they are not only based on the economic merit, they are also based on what? They are also based on their own protectionist policies, and they want to stop the export or import of a particular goods or service or anything like that. The objectives of levying this instruments or making use of these instruments is discretionary with the country which is dealing with it. So in this unit, first let us start with the tariff measures which we have to discuss. Now, first the question will come as to what is tariff, right? This could be one of the question, right? A 2-mark question. What do you mean by tariffs? Name at least 4 different types of tariffs applied in the international trade. These kind of questions are possible. Tariffs are also known as custom duties, right? You might be very familiar with this terminology called as custom duties. They are basically nothing but taxes, right? Or duties which are imposed on goods and services which are imported or exported, okay? But mostly we'll be dealing with the tariffs which are being applied on the imports, okay, rather than the exports. Our concentration will be more on the import tariffs, right? Now, it can also be called as a financial charge in form of tax, etc. Now, how many types of tariffs are there? There are a lot of types of tariffs, which we definitely have gone through all of them with the help of an example. So in this revision lecture, we'll try to go through that again, right, in a very swift format where we'll understand what those tariffs are. And then you can go back to the notes and have a look at it and get a better clarity on that, right? So let us go into the next part, that is going to be the forms of tariff, right? What are the various forms of tariff? And the first one in that comes as specific tariff. Specific tariff. Now, what do you mean by specific tariff? Very simple. It is about a specific tariff is a fixed amount of money per physical unit or according to the weight or measurement of a commodity which is being imported or exported. What did I say? It is a fixed amount per unit or per, let us say, kg, per liter, or any kind of measurement, okay, that you can do on that particular product, right? So it is a fixed amount. In the sense, if I import one cycle, let us say the import duty on that is 500 rupees if it is a specific tariff, and if I import 5, is going to be 500 into 5, right? That is 2500 rupees will be the specific tariff. Now it's a very important thing to know that this particular cycle could be a very high value cycle, okay, and these 5 cycles could be a low value cycle, but here value is not considered. In specific duty, what is considered? Only the physical units, how many units come in, and on those units we are going to charge tax on a particular rate. Okay, that is about what? Specific tariff. Let us go to the second one. Second one is called as ad valorem tariff. Ad valorem. Ad valorem, the word itself is the, gives the meaning to it. Ad valorem means on value. Okay, it means on value. In the sense, here what will happen? The tariff will be given in the form of percentage, which means what I have to do? If I import one cycle, I am going to arrive at the value of that cycle. Okay. Now, how to arrive at the custom valuation, that will be covered in your CA finals in the subject indirect taxes, where you will learn about custom valuation rules, right? Here, just understand that we are going to ascertain the value. Okay. Let us say at 20,000 rupees is the value of that cycle, multiplied by, let us say, the tax rate is 10%. In that case, we are going to pay 2,000. If the value of the same cycle is going to be 40,000, then you are going to pay 10% of that. That is going to be 4,000. Here, what will happen as the value increase, right? As the value increase, the tax collection of the government also will increase. That is one thing that you have to understand. And then there are other forms of taxes. Let us, go ahead and learn the other. Now, other forms, the third one I'd like to call is something called as mixed tariff. Okay, mixed tariff. Mixed tariffs are expressed either on the basis of the value of the imported goods or on the basis of unit measure of the imported goods, depending on which generates the most income. That is, mixed tariff is nothing but specific duty, they will have one, ad valorem duty, they will have another one. So whichever is higher will be used, okay, by the government, whichever generates the maximum revenue for them. That is called as mixed tariff. And then we will have the fourth type. Fourth type is called as what? Compound tariff. Compound tariff, or it is also called as compound duty, right? Now it is what? It is a combination of what? Specific and ad valorem. So here, how the taxes will be ascertained? If you import, let us say, one cycle, they are going to say it is going to be 500 rupees plus 5% of the value. It is going to be 500 rupees plus the 5% of the value. So here I have used both specific as well as ad valorem, right? So this is called as what? Compound tariff or compound duty. Then we have something called as, technical tariff. Technical tariff. Okay. Technical tariffs are calculated on the basis of the specific content of the imported goods. For example, if you import, let us say, the a solar panel. Okay, you imported, let us say, solar panel. Okay, and on this panel, okay, the tax will be less, but on the battery, the tax will be more. Okay, now why is that? There are a lot of reasons, because solar panels will help you in sustainable energy, where batteries are manufactured in every country, hence the taxes are more. Here, technical tariff means what? I'm going to break down on the basis of specific content of the imported goods, and I'm going to charge tax on the same. Next, we have something called as tariff rate quota. Okay, tariff rate quota. They are nothing but they combine two policy instruments, that is quotas and tariffs. What do you mean by quota? Quota means a specific number of items which will be allowed. Okay, imports entering under a specified quota, I should say, are usually subject to a lower amount of tax. For example, let us say that there is a company called as A Limited, and they are going to import a dangerous chemical. Okay, a dangerous chemical called XYZ. Okay, now this chemical is very dangerous for the environment and to the society, but it is a must, okay, to make sure that certain chemicals are manufactured. Now, in that case, government want to restrict the import, as well as government cannot put a ban on the import. At that time, what will they do? They will give a tariff rate quota, which means under a particular quota, right? If a year, in 1 year, if you import up to 100 kg, then the tax is only 1%. But if you import anything more than 100 kg, the tax is going to be 50%. Right? Are you understanding what it is? It is to control through the help of quotas, also to collect revenue in the form of tariff. This is called tariff rate quota. Let us go to the next one. Okay, it is called as most favored nation tariff. Okay, most favored nation. Now, what happens in most favored nation tariff? These refer to the import tariffs which countries promise to import on the other members of the WTO. Now, about WTO, we are going to learn in the later stage in the third unit of this chapter. But understand that there is World Trade Organization and there are so many members, right? Now, all these members agree to charge a specified number, a specified percentage of tax on each other, right? That tariff is called as most favored nation tariff. Okay, that is as simple as that. Next is something called as variable tariff. Okay, variable tariff. What do you mean by variable tariff? Very simple. It is typically fixed to bring the price of an imported commodity. Second. Okay. It is typically fixed to bring the price of an imported commodity up to the level of domestic support price of the commodity. Okay. Now, what happens here? Okay. Imagine that there is a product. Okay. Let us say there is tomatoes. Okay. I'm just giving you example just to make you understand. Okay. These are not any of the real, scenarios. Now, imagine that tomatoes are produced at a very too much extent in our country, and the price of the tomato which is currently trading in the market is 8 rupees per kg. Okay, 8 rupees per kg. Now 8 rupees was too less, so government came up and government said that a minimum you should pay 10 rupees per kg. Okay, so they gave something called as minimum support price. Okay, or let us say a support price for the tomatoes. Now, what happened? All the vendors who are the middlemen who are buying the tomato, they said that no, we can import tomatoes, we'll get it at 5 rupees, right? So why should we pay 10 rupees for the things where we can get it at 5 rupees? Fair point, right? So they started importing. So what did government do? Government said that, okay, no problem, you import it at 5 rupees, but when they come to the dock, I will charge a variable tariff of another 5 rupees to make it equal with the domestic support price. So I will make the vendors indifferent between importing and paying the minimum support price to the farmers in India. Now, this tariff, which is charged differential, okay, or let us say variable tariff, that is called as variable tariff. Okay, that 5 rupees is called as variable tariff. I hope you understood that point. Let us go to the next type of tariff. That is called as preferential tariff. Now, see, all the countries in the world are either a part of at least one preferential trade agreement, okay, under which they promise to give another country's products lower tariffs than the MFN rate. We just learned about what is the most favored nation tariff. That is what WTO members promise each other, that this is the maximum we are going to charge you. But then you can have a preferential trade agreement with your immediate neighbors. Okay, let us say India is a part of SAARC. Okay, the Gulf countries have a union, European countries have a union, right? There is Asian countries have a ASEAN as one of the union which they have. In that, what they do, they charge, they agree with the WTO that what is the MFN tariff, but they will charge something even lesser than MFN. Okay, and that is called as preferential tariff, which is charged between these countries which have preferential trade agreements. Okay, next one is called as bound tariff. Now, what is bound tariff? Let me tell you. Under this, it so happens that a WTO member, any WTO member country, binds itself with a legal commitment not to raise tariff rate above a certain level. It will bind itself to a tariff rate. Okay, understand what is happening. I bind myself not to charge above a particular rate to a country. Okay. Now, by binding a tariff rate, often during negotiations, the members agree to limit their right to set tariff levels beyond a certain level. No matter what happens, we will not charge more than 20% for IT. No matter what happens, we will not charge more than 50% for automobiles. These kind of tariffs, okay, are put up. Okay, bound tariff is put up. Now, why this kind of bound tariffs are put up? Let me give you a clarity. Okay, imagine that you in for example, in Gulf countries, right? It is not possible to have a lot of agricultural products, so they have to import. Okay, when they're importing, what will they do? They will give offer to a developing or underdeveloped country to grow certain vegetables which they like to eat in Gulf countries, and export them from there, and so that they can import it in Gulf countries and have food. Now it so happens that after certain years, okay, when the of course, when you just say that I want, you have to make sure that you do the process of agriculture and get the fruits. It takes time, right? So if it takes 2 to 3 years to come to the output level of the Gulf countries, but before that, if Gulf countries find some other supplier who is going to supply it at a lesser price, right? All that you have grown will still be there in your country itself, right? So Gulf countries won't import. So what you're going to do, you're going to bind them to a rate. You have to say that you are not going to raise the tariff above particular rate, okay, after some time, right? Even if something happens, right, later, the developing or underdeveloped countries should not be at a disadvantage. This is one of the use cases of bound tariff, right? Then let us go to the next one. It's called as applied tariff. Okay, applied tariff. Now, what is applied tariff? Applied tariff is nothing but the duty which is actually charged on the imports on a most favored nation basis. A WTO member can have an applied tariff for a product that differs from bound tariff for that product as long as applied level is not higher than the bound level. See, there is on top, there is MFN, and then there is a bound tariff, and then there is applied tariff. Okay. MFN, all the countries of WTO members will agree that they will not charge more than 20%. Then I bind myself to a rate of 15%, and then I apply the tariff of only 10%. Okay. But this applied tariff cannot be above the bound tariff. This we have learned in bound tariff, isn't it? Once I bind myself, I cannot go out of it, right? So applied tariff cannot be above the bound tariff, but applied tariff can be less than, right? So what is actually applied? Next, after this, we will go to something called as escalated tariff. Escalated tariff, right? So what is escalated tariff? Let me give you an example and you'll be clear with that, right? So imagine this. If you import cotton, tax is 5%. But if you import textiles, the tax is going to be 25%. Now understand why? Because if you import the raw material, you are going to do manufacturing in India. You are going to generate employment in India. You are going to bring in a lot of foreign currency by exporting. right? A lot of things are going to happen if we import the raw material rather than importing what? Just the finished product. So government, in order to boost the manufacturing sector, right? They give this escalated tariff. They say that you import raw material, no problem. But if you import finished goods, then you pay higher amount of tax. This is nothing but escalated tariff. Next, there is something called as prohibitive tariff. Prohibitive tariff. Now, what is prohibitive tariff? It is set so high. It is set so high that no imports can enter. Okay, it is so high that no imports can enter, right? When you want to import something which is bad to the society, government might not just ban it. They can just say that the tax is, certain hundreds%. Okay, and when that happens, people won't be importing it. It's as simple as that. Prohibitive. It's like a indirect ban on import. Okay. Now, in the classroom scenario, we have seen so many practical rates and all that. We have gone to the website and we have seen so many practical rates and use cases of, these tariffs, right? So that we can't do here. We'll just be taking a small examples and we'll be moving forward. Next, there is something called as import subsidy. Import subsidy is nothing but like a opposite of tariff, right? So when you import, rather than you paying money, government will pay you. Now, which sector it happens? During COVID-19, if you had imported certain medicines, during COVID-19, if you had imported PPE kits, during normal, during time of agriculture, if you have imported some agrotech machinery, right? Government will pay you subsidy for importing those products, right? So if you get good tech into India, they will support you by giving import subsidy. That is what is called as. Next, there is the tariffs as a response to trade distortions. That is, whenever there is countries engage in some unfair foreign trade practice, the one country will put up a lot of tax on the other. So that is called as tariff as a response to trade distortions. And then there is anti-dumping duty. Okay, it's important from examination point of view. Anti-dumping duty. Okay, it is nothing but, see, dumping has got nothing to do with the quantity. Like we say, China dumps the product into India, right? So dumping has got nothing to do with the quantity. It has got everything to do with the price. Okay. So what they will do, they will, dump the products into India at a very less price, probably lesser than the cost, just to get the market share in India. Right. In that case, government, what it will do, it will bring it back to the domestic price, okay, by charging the differential amount as tax. That is called as anti-dumping duty. Next, we have countervailing duty. Countervailing duty. We know that on goods in India there is GST, but there are many countries in the world where there is no tax on the goods and supply or sale of goods. So when they come to India, because of not having GST in their own country, their products will be cheaper, right? So our domestic suppliers will start shouting. They say that, okay, they have not charged GST. That's why they are cheaper. They are taking our market. So government say, no problem. I will charge tax on them in the form of CVD. We call it as CVD, right? That is countervailing duty. Okay, that is regarding that. Then, with that we have finished what? The tariffs which were there. So we will learn some small point there, which is called as what are the effects of tariff? What does tariff do? Okay, we already know tariffs act as a barriers to create obstacles of trade, right? Sometimes tariffs are set so high that your importing dreams will be crushed, right? So you want to import a product, but the tariff is so high that it's almost coming to double. For example, you can talk about all the sports cars and big supercars, right? The taxes on that is huge. Almost the cost will be doubled when they get to India, right? So in that case, a lot of people who have the mind to buy it are not able to buy it because of the taxes, right? They create obstacles to trade. Then, by making imported goods more expensive, tariffs discourage the domestic consumers from consuming foreign traded goods, right? So domestic consumers suffer a loss in consumer surplus. We know that, okay, although we are coming up in manufacturing, our product qualities are not inconsistent with the product quality of the rest of the world. So if you want to enjoy the product quality of a foreign country, you are not able to do so because of the tariffs which are set very high, right? And tariffs encourage consumption and production of the domestically produced import substitutes and thus protect the domestic industries, isn't it? Right? So whenever you discourage the imports, people will consume. People have no option, right? They will consume the domestic products, and with that, domestic industries will bloom. That is what the point there is. And there are some other points that producers who are from the importing country experience an increase in the well-being, right? The producers of the importing country, right? So they experience an increase in well-being as a result of imposition of tariff, right? So when the tariffs is put on the imported product, the domestic producers are very happy, right? And the price increase also induces an increase in the output of the existing firms and possibly addition of the new firms, right? So whenever imported product becomes costlier, people will look for domestic products. That will increase the demand for the domestic product. And indeed, once the demand is increased, new players will come in, new manufacturing will happen, new jobs will be created, right? That is all, the effect of the tariffs. Okay, then there are some other points. You have to remember around 4 to 6 points there, right? A 4-mark question is possible as to what is the effect of tariffs. Okay. Then we'll go into something called as non-tariff measures. What are non-tariff measures? Let us learn. See, we did discussion of tariffs before, and we learned that tariffs constitute the visible barriers to trade and have the effect of increasing the prices of imported goods. But non-tariff measures, which have, what, they are not visible like the, tariff measures. They are kind of invisible in the form that they come in terms of specifications, rules, and regulations. Now, with that, the price of the product might not get costlier, okay, but importing will become a little bit difficult. Okay, that the process itself will become more difficult. Now, how is that? Let us learn. In non-tariff measures also, there are two different types. One is called as technical, and second one is non-technical. Okay. First, let us look at the technical measures. Okay, in technical measures, right? What do we have? They refer, first of all, what do you mean by technical measures? Technical measures refers to the product specific properties such as characteristics of the product, technical specifications of the product, and production processes of the product. These things are, taken into consideration to ensure the quality, safety, environmental protection, food safety, national security, and protection of animals, protection of plant health, protection of environment as a whole. All these things are considered in technical measures. Okay, now once we go into the detail of the technical measures, you will understand it much better. So technical measures, again, there are two types. Okay, again, there are two types. One is called as sanitary and phytosanitary measures. And second one is technical barriers to trade. Okay, so let me explain to you what is sanitary and phytosanitary measures. See, these are applied to human, animal, and plant life from risk arising from additive, pest, contaminants, toxins, or disease-causing organisms, and to protect the biodiversity. Now, understand, in the classroom, I had given you example of the Congress grass, right? During the time of the emergency and later when India was struggling, we imported wheat, and with that came a lot of seeds which started growing in the streets of India, and they're still there, right? So what happened? Because we did not have proper sanitary and phytosanitary measures, right? All these things came into India, and the plant life got affected in India, right? These kind of things do happen, right? So these are the measures which are called as sanitary and phytosanitary measures. There are a lot of specifications which are provided. Next, there is technical barriers to trade. Okay. Now, these are nothing but these cover both food and non-food, traded products, refer to mandatory standard and technical regulations that define the, specific characteristics of the product which has to be there. such as it could be the size, it could be the shape, it could be the design, it could be labeling, it could be marking, it could be packaging, it could be functionality, it could be performance, it could be anything, right? Even production methods that this. So a small example, like in from India, when we exported saris into the United States, right? United States rejected them for having more of a flammable characteristics, right? They say that the fire is easily catchable on these clothes, and they rejected that. It was a big issue a couple of years back. So what happens is when US authorities, they have a very stringent technical barriers to trade. They say that we want these specifications only, right? If these specifications are not followed, we will not import, and all those kinds of things. These are called as technical barriers to trade. They also include certain food laws, right? Certain countries have that if your food product contains more than these, more than particular level of saturated or unsaturated fat, then we will not allow it. And all those kinds of things are there, right? Especially in Gulf countries. So these are called as technical barriers to trade, right? And with that, we have finished the technical measures. So let us go to the non-technical measures, right? What are the various non-technical measures? So let me cover that, right? In non-technical measures, right? First one we have, right? I will start it over here. First one we have is import quota. And import quotas we have already learned, right? It is a direct restriction. We say that, see, we had seen tariff rate quotas, right? Where if you import it under a particular, quota, then the rate was less. And if you import more than that, the rate was more, right? Here, import quota is a bit different. They say that you can import only so much, okay? If at all you are importing a particular chemical, they say that, okay, 100 kg is what is allowed per year. After that, you can't, right? Even if you are willing to pay more, you can't, right? Now, these are called as import quotas. They will allow only particular, units, okay, or particular, quantity of goods. Next, there is something called as price control. Price control measures. Now, what are price control measures? These are the steps taken to control or to influence the prices of imported goods in order to support the domestic price of certain products when the import prices of these goods are lower. Okay. So you are going to control or influence the prices of imported goods in order to support the domestic price. Okay, sometimes it so happens that when you import the a particular product which is currently could be trading at 100 rupees in India, but in a particular season the prices, if you import that, might fall to 50 rupees. But in that case, if you import it at 50, what is going to happen to domestic industries? They're going to have a problem, right? So they are going to, the government is going to influence or control the price of this imported goods, okay, through these price control measures. Next, there is non-automatic licensing. Non-automatic licensing and prohibitions. Okay, now what are these? These are normally aimed at limiting the quantity of goods that can be imported, regardless of whether they originate from different sources or from a particular supplier. For example, India prohibits the import or export of arms and related material from or to Iraq, right? So what happens? A complete prohibition is put, okay? Probably based on the need, you might have given a license to a firm to import particular products, but they are non-automatic, which means what? Which means every time you have to import this, you have to get a license from the government. So with that, what happens? There is an indirect prohibition, okay, on this the import and export of certain products to or from a particular country. Next, we have something called as financial measures. Okay, financial measures are nothing but regulating the foreign exchange which is required for the import. See, you are here in India and you are going to get something from the USA, right? The goods come in, now you have to pay that. While paying them, can you pay them in Indian rupee Answer is no, you have to pay them in dollar. Now you don't have dollars. Where will you go? You will go to the bank, and there they will restrict you by giving you only certain amount of dollars. So these are called as financial measures. They will control your pocket rather than controlling your intentions, right? So they will not release enough dollars for you to import, right? These are called as financial measures which are applied for, as a part of non-tariff measures which are non-technical. Okay. Then we have something called as measures affecting the competition. Okay, measures affecting the competition. Now here are what happens. These are aimed at granting exclusive or special preferences or privileges to one or few limited group of economic operators. It may include the government imposed special import channel or enterprise and compulsory use of national service. For example, a statutory marketing board may be granted exclusive right to import wheat. Okay, what happens here? If you let everybody import, okay, and everybody will quote different prices to the supplier, even the imported product will be standing costly. And best example I can give you one more is petroleum, right? Now the crude oil cannot be imported by anybody and everybody, right? You need to be in a particular, sector, and you need to have certain licenses to import petroleum crude into India, right? Why? Because we do not have it in abundance, and if everybody starts doing that, right, and it will amount into competition, and there can be a price instability which is possible over there, right? That is why we affect the competition that way. Next, there is something called as government procurement policies. Okay. Government procurement policies means what? See, it mandates that the whole or specified percentage of government purchase should be from domestic firms rather than foreign firms. Let us say that now, government wants to build a flyover, right? Government wants to build a flyover, or government wants to build a highway, or it wants to build metro, it wants to build a solar power plant, right? In that case, most of the product they might be importing, okay, but there is a specific clause which is it could be such that the 30% of the total government purchases should happen from domestic industries. Why? Because domestic industries will get some business, they will also bloom, right? Our industries in India will bloom. So government procurement policies means that. And then we have trade related investment measures, okay, in the sense these include rules on local content requirement that mandates a specific fraction of the final good should be produced domestically. It can be a requirement to use minimum level of locally made components. Okay, automobile company from foreign might come and start plant in India, but if they import all the parts from the foreign country, where domestic industry will not grow. So at least nut and bolts you buy from India, right? At least seeds you buy from India, right? These are called as trade related investment measures. Okay. Then there are distribution restrictions. What do you mean by distribution restrictions? You can import a particular product, but the distribution of that product is not, you cannot do the distribution in all of the country. You can do it in a part of the country, and all those kinds of rules are put in place, right? Geographical restrictions, you can say, or restrictions, to resell, okay, where and all you can do that. Those kind of rules are given. In the classroom, we have taken a very elaborate example for this, which we cannot take because of time. Next, we have restriction on post-sales service. Okay, restriction on post-sale service. Now what happens is, okay, if you want to import a car, no problem, at least do it servicing in India, isn't it? Right? So at least when you do servicing, at least job will be created in India, probably some manufacturing will happen in India, right? So if you want to import the product, no problem, but at least the post-sale service you have to do in the domestic country. Those kind of rules are called as restriction on post-sale service. Then there is administrative procedure. Administrative procedure, they say, make the administrative procedure so difficult that imports will be restricted automatically. Okay. So basically make the importer run from pillar to post, right? So one, come tomorrow, get that certificate, get this certificate. Oh, this certificate is old now, get a new one. Right? Come after 3 months. Commissioner is not there. We are on leave. Right? All these kinds of administrative procedures, or get a license from some authority which is there in Delhi. Right? You are in South India. Now you have to go there and get it from Delhi. Right? There are so many problems. You have to like, I don't want to import them, right? Directly, they will never say that, okay, stop importing. They'll say you can import, but follow this procedure, these administrative procedures, which are hefty, right? And then next one, there is something called as rules of origin. Now, rules of origin. What do you mean by that? Okay. See, the country which is the where the good is produced, or in case of a traded service, the home country of the service provider. The rules of origin are the criteria needed by the government for importing, countries to determine the national source of the product. So it so happens that we allow certain products to be imported from certain countries only, right? So rules of origin means that we have to actually look at from where those products are coming. Okay, if they're coming from particular countries, we allow it. If they're coming from certain other countries, we will not allow it. It's as simple as that. Next, there are something called as safeguard measures. Okay. Now, what do you mean by safeguard measures? These are initiated by the countries to restrict import of a product temporarily if the domestic industry is injured or threatened with the import which has been recently surged, okay, or for a particular product in India, right? So suddenly, if you see a lot of increase in the import of textiles, suddenly these safeguard measures will be put in place. Okay, because we know that textile is one of the major sector in India, and if you see a lot of import, there could be a chance that domestic industries will suffer, right? And then there is embargo. Embargo is nothing but a complete ban. Okay, complete ban on products, okay, originating or certain products which are considered dangerous for the society, right? Government will come up with the notification from time to time on what product they want to put embargo and what product they don't want to put embargo on, right? Now, these are all the non-technical measures. Okay. Now, if there are any doubts with regard to this, the measures which we have taught, okay, please, it is the time to ask before I go into the export related measures. I will wait for 1 minute. Okay, I will continue with the export related measures now. Everybody concentrate. Export related measures. Okay. There are, broadly I can divide that into 4. So I'll directly go into the first one there. First one is ban on exports. It is pretty straightforward. Okay, I'm going to ban the exports. Okay, why? What? The reasons could be different from the government. Must have different reasons to do this. Okay, for example, during the summer where the milk production is less in India, right, due to lack of water and all that, certain milk products export might be put on ban, right? So wherever those products are required to be used in India, if there are necessity in India, at that time the ban on exports is usually put. Okay, so these are all measures which are applied by the government of the exporting country, including both technical and non-technical measures. Okay, everything they will use to make sure that certain exports are banned. Okay, then there is something called as export taxes. Now, export taxes for all, most of the practical purposes, export taxes is something which doesn't exist because all the WTO members have come into a proper understanding which say that, export your goods and services, but don't export your taxes. That is what is the phrase which is usually used in the foreign trade, which means that on your export, don't put taxes. But if you are the sole, supplier of that product in the entire world, and your product has a lot of demand, and also it is scarce, in that point, it is not wrong on the part of the government to make some revenue out of it, right? So certain products are taxed, which we have the upper hand. Okay, in that we can charge some export taxes, just like import taxes. It is charged on the exports, and they are called as export tax. Simple. And then third one is export subsidies and incentives. Okay, we do know that whenever we are exporting, right, government gives us a lot of benefits. Okay, because exports means a lot of foreign currency into the hands of the government, a lot of money coming into the economy, a lot of employment generation. So government wants to promote exports. Okay, so it gives a lot of export subsidies and incentives. And then the last one, there is voluntary export restraints. Voluntary export restraint. Okay, what do you mean by voluntary export restraint? It refers to a type of informal quota administered by the exporting country voluntarily, restraining the quantity of the goods that can be exported out of the country during a specified period of time. Now, why, how, and all that, I have given you an example of Japan and US in the classroom scenario. This is an elaborate example, right? Where I told you why countries go for this voluntary export restraint. For the purpose of just understand this, right? Exporting country itself will stop the exporters from exporting the product to a country on the request of that country which is importing, right? So that means that these two countries have very good trade relations, and they accept each other's request on the basis of merits. Okay, now these are called as voluntary export restraint. Now with that, we have finished the revision of the unit 2 of the international trade, that is going to be the instruments of trade policy. From the examination point of view, any of the two, okay, it is usually so that in the every exam, economics for finance, two of these things are usually asked. Okay, one from they can ask about tariff or non-tariff measure. They can just ask you what is export subsidy. They can ask you what is tariff rate quota. They can ask you what is ad valorem tariff. They can ask you what is escalated tariff. They can ask you what is sanitary and phytosanitary measures, right? So they can ask you even to write a short note on that. So it depends upon the mark. Okay, if there are only 2 marks, you write the definition. If it comes for 3 marks, you write the definition as well as an example, right? So you can make your answers look better on the basis of for how many marks it has been asked. So this is about unit 2, that is instrument of trade policy. Any doubts, please put it up in the chat box. I will answer those. Okay, I take it as there are no doubts in this particular unit. I hope you have understood and you're able to revise with me whenever I'm doing this particular topic, right? So the next unit onwards, we will take up in the next revision class. For today, this is enough. Make sure that you study all the things that I'm talking about properly, and you revise the entire syllabus before going exam. We'll meet you in the next class. Bye.